Before we begin, this video is for educational purposes only and is not financial advice. Always do your own research before making any investment decisions. If you've been researching investing, you've probably seen the terms index fund and ETF used almost interchangeably, sometimes in the same sentence. But are they actually the same thing? And does it even matter which one you choose? In this video, I'm going to clear up the confusion once and for all. What index funds and ETFs actually are, how they differ, and which one makes more sense for you as a beginner. Let's get into it. Let's start with index funds since they came first. An index fund is a type of investment fund that tracks a market index. A market index is simply a list of companies grouped by certain criteria, like the S&P 500, which tracks the 500 largest companies in the US, or the MSCI World, which tracks around 1,500 companies across 23 developed countries. Instead of a fund manager picking and choosing which stocks to buy, which is expensive and statistically ineffective, an index fund just automatically holds all the stocks in its target index in the same proportions. If Apple makes up 5% of the S&P 500, the index fund holds 5% Apple. Simple, passive, low cost. Index funds were invented in the 1970s by John Bogle, the founder of Vanguard. His idea was radical at the time. Instead of trying to beat the market, just own the entire market. Decades of data have proven him right. The vast majority of actively managed funds fail to beat simple index funds over the long run. So an index fund is defined by what it tracks, a passive index, and how it's managed automatically with no active stock picking. Now here's where people get confused. An index fund is a strategy, but ETFs and mutual funds are structures, different ways of packaging and delivering that strategy. And this is the key distinction most people miss. We covered ETFs in detail in a previous video, but let's quickly recap. ETF stands for Exchange Traded Fund. The key word is exchange traded, meaning it's bought and sold on a stock exchange throughout the day, just like an individual stock. You open your investing app, search for the ETF, and buy or sell it at any point during market hours at the current market price. Now here's the crucial point. Most ETFs are index funds. They track a passive index. But not all ETFs are index funds. There are actively managed ETFs where a fund manager picks the stocks. These are less common and generally more expensive. And crucially, not all index funds are ETFs. Some index funds are structured as mutual funds instead, which work completely differently in terms of how you buy and sell them. So the relationship looks like this. Index fund is the strategy. ETF and mutual fund are the structures. Most ETFs use an index fund strategy. Most index funds in Europe are available as ETFs. But they're not the same thing, even though people often use the terms as if they are. Since most index funds you'll encounter as a European beginner come in ETF form, the more useful comparison is actually ETFs versus mutual fund index funds. Let's break down the key differences. The first difference is how you buy them. ETFs trade on a stock exchange throughout the day at real-time prices, just like buying a share of Apple. Mutual funds, on the other hand, are priced once per day after markets close. You place an order and get whatever price the fund calculates at end of day. For long-term investors, this doesn't matter much, but ETFs give you more flexibility and transparency. The second difference is minimum investment. Traditional mutual funds often require a minimum investment, sometimes 500, 1,000, or even 5,000 euros to get started. ETFs have no minimum beyond the price of one share, which for many popular ETFs is under 100 euros. On platforms like Trade Republic, you can even buy fractional ETF shares for as little as €1 per month through a savings plan. The third difference is fees. ETFs are generally slightly cheaper than equivalent mutual funds because of how they're structured. For European index investors, the difference is often small, but over 30 years, even a 0.1% fee difference compounds significantly. The fourth difference is availability. In Europe, index mutual funds from providers like Vanguard are not always easily accessible to retail investors. ETFs, on the other hand, are available on virtually every European broker and investing app. Trade Republic, Scalable Capital, and others all offer a wide range of ETFs with no commission on savings plans. Here's the honest answer. For a beginner investor with a long-time horizon, the difference between an ETF index fund and a mutual fund index fund is minimal in terms of outcome. Both give you diversified exposure to hundreds or thousands of companies. Both have very low fees compared to active funds. Both benefit from compound growth over time. Both are perfectly valid ways to build long-term wealth. The reason ETFs have become the dominant choice for European retail investors, especially beginners, comes down to three practical things. Accessibility. You can buy them on any modern investing app in seconds. Flexibility. No minimum investment beyond one share or even less with fractional investing. And cost. Marginally lower fees on average. If you're using Trade Republic or Scalable Capital, you're going to be investing in ETFs almost by default because that's what these platforms are built around. And that's perfectly fine. The iShares MSCI World ETF, the Vanguard FTSE All World ETF, these are index fund ETFs, and they're exactly what most beginner investors need. So which should you actually use? For most European beginners, the answer is simple: ETFs. Here's why. They're accessible on every major European platform. They have no meaningful minimum investment. They're commission-free on savings plans through platforms like Trade Republic. They're transparent, liquid, and low cost. And the most popular ones, like the MSCI World and FTSE All World, track broad global indexes, giving you instant diversification across thousands of companies. If you're already set up on Trade Republic or Scalable Capital from our previous videos, you're already investing in ETFs. You don't need to change anything. Just make sure the ETFs you're choosing track a broad passive index, like the MSCI World or S&P 500, and keep the TER under 0.25%. That's it. Index fund strategy, ETF structure, broad global diversification, low fees, long time horizon. That's the winning formula for beginner investors, and it doesn't need to be more complicated than that. So to recap, an index fund is a strategy that tracks a market index passively. An ETF is a structure for delivering that strategy on a stock exchange. Most ETFs are index funds. For European beginners, ETFs are the most practical and accessible choice. And the difference between the two in terms of long-term outcomes is minimal. What matters far more is starting early, staying consistent, and keeping your fees low. If this video helped clear up the confusion, subscribe to SimpleWealth. We post simple beginner investing content every single week. Drop your questions in the comments, and we'll see you in the next one.